I'm probably thinking the exact same thing that you're thinking right now. Gold. Gold should be exploding vertically right now. Silver should be going parabolic, vertiginously. The world is closer to global conflict than it has been in decades. Iran, Taiwan, Russia, Ukraine, global arms race, Japan rearmament. Global arm races between major powers like it's never been before in our living memory. And yet, what's happening to gold? It's hesitating, it's hovering. Silver is drifting sideways or going down. So what's going on? What's actually happening in these markets? Because the real driver of metals is never war. It's always liquidity, debasement, and the fear of debasement. And right now, one hidden mechanism inside the financial plumbing, inside the financial system, is quietly suppressing the very assets that should be exploding. So why? Most people are watching the headlines, most people are watching the apocalyptic news flow, but they're missing the important plumbing. And by the end of this video, of course, you're going to see exactly where the pressure leaks. So let's talk about what everyone believes and why it's probably wrong. It's the old rule that governs this system and the way of belief systems in our human brains.
The old rule. War equals gold.
For decades, investors have been trained to believe one simple rule. War equals a gold rally. And you can understand why that is the expectation, why that is the assumption, right? It makes intuitive sense. It makes logical sense. War destroys stability. War destroys predictability. War is uncertainty. War creates absolute fear and instability. And war threatens regimes, it threatens countries, it threatens currency systems, it threatens financial systems. So what happens? Investors in that time, they turn to gold, they turn to precious metals, they turn to areas of the market where there's no counterparty risk, where things can't get printed ad infinitum, and where you can hold something with actual physical, real asset value. And sometimes that rule absolutely works. For example, when the Soviet Union ended, and before it invaded Afghanistan in 1979, gold exploded higher. During the first Iranian Revolution, the same year in fact, gold surged from around $200 to $800, a 4x. In 2001, after September 11 attacks, gold began a decade-long bull market. And most recently, in 2022, when Russia invaded Ukraine, gold initially spiked again. So people look at today's conflict and they think one simple thing. They think of the parallels. Why isn't the same happening right now? Why isn't the same thing that happened in all of those playbooks occurring right now, all over again? Why aren't the metals exploded? Why aren't real assets repricing vertically? Because the rule itself is wrong.
The rule is wrong.
The way we're thinking about these markets is entirely wrong. War, in fact, does not actually drive the price of gold. It never has. It's always been liquidity, the fear of debasement and the expectation, the front-running of eventual stimulus and governmental largesse. And that distinction is what explains everything. When you think about it rudimentarily, when you think about it fundamentally, when you think about what drives the flows into gold, it's never war. Always the bid for a war bid is always into the dollars, or what they perceive as safe governmental assets, never into precious metals. It's purely a function of interest rates and of liquidity. So the real mechanism behind gold is a little bit more complicated, because gold doesn't respond to bombs. If it did respond to bombs, we would have seen an absolute vertical ascent of the price of gold, which would be logical to all of us, because as I said before, war equals instability, war equals uncertainty, war equals a rush to safety. But gold responds to financial stress inside the system, not war-driven stress. More specifically, gold responds to liquidity expansion, or to liquidity contraction, or to liquidity scarcity. And when central banks flood the system with money, gold rises. And you better believe it, if this continues any longer, the central banks are going to flood the system in a diluvian, Noah-esque way like you've never seen before. Because when liquidity tightens, that's when gold stalls. When the denominator no longer enlarges in terms of the dollars being printed, that's when it stalls. Let's look at a simple example to reinforce my point. During the 2008 financial crisis, what happened? The world faced massive economic stress. No bankers went to jail, but nonetheless, I digress. But gold would have expected to immediately explode, but it didn't. In fact, what happened? It fell sharply at first. Gold didn't explode, even though we were facing the most apocalyptic financial crisis that we've known in a generation. Because investors did one thing. They didn't buy gold, they were desperate for cash. They were desperate to raise dollars. They sold everything, including gold, and they only wanted to save in cash. Gold only began its real major ascent after the Federal Reserve came in and did their Draghi moment and said, we'll do whatever it takes to keep this system going. The moment the liquidity flooded the system, metals exploded higher. The same pattern always repeats over. 2020, if you look back, at the start of the pandemic, gold dropped almost $200 in days. The same questions were being asked. Why is gold not rising? It's the end of the world, literally. Again, not because gold lost its value, but because the system was waiting for the eventual liquidity to come. And the same thing is going to happen this time if this war prolongs itself. Once the Fed unleashes trillions of dollars in stimulus checks, in QE, gold is going to be reaching all-time highs again and again and again. So the pattern is quite clear. It's just that our thinking isn't. Gold rallies not when the world is chaotic, but it rallies when the liquidity expands. It rallies when the denominator loses its value. It rallies when the United States dollars and the other currencies all around the world start to be printed ad infinitum. The hidden system that controls all of this is actually not hidden at all. It's in plain sight. But for some reason, we've got some kind of warped recency bias that makes us believe that war and famine is what's bullish for gold. But we've been proven incorrect with that time after time. Now we arrive at where most investors don't actually see the forest for the trees, because gold is not just a metal. Gold is also actually a financial asset traded through derivatives. The majority of that gold trading does not occur in physical bars, like in the Swiss vaults. That's an archaic way of thinking about the market. It happens through complex derivatives, futures markets, swaps, ETF derivatives. Flows into these products is what actually drives the price of gold. Real speculative asset allocation and real portfolio asset allocation. It's only central banks that actually store the physical stuff. The rest of it is dealer hedging, options positioning, gamma exposure, liquidity flows, capital flows, ETFs, CTAs. These mechanisms are what really shape the price movements. For example, think about when a large institution buys calls on gold. Call options on golds. Dealers who sell the options, they have to hedge their risk, obviously. That hedge involves buying futures contracts in the futures markets or selling futures contracts in the futures markets to hedge their risk, depending on which directionality they're trying to express. Now, that hedge often involves buying those contracts or selling those contracts, which means the price of gold can become trapped in a kind of, in a loop. In certain levels, inside certain levels of psychological levels or certain levels where they've VWAP'd in, they bought at a certain average price and they have to be hedged at a certain average price. And that creates the gamma walls that traders always talk about. Now, the gamma walls and gamma squeezes aren't only in equities, they also occur in gold. And when the gamma walls suddenly stall, something really interesting happens. Derivatives markets have to absorb all of the moves. To the average investor, it looks mysterious. Why is gold dropping $200 in a war? Why is gold going up $400 on no news whatsoever? But it's the inside plumbing, it's the mechanism that's causing it to go up like that. The dealer flows, the option positioning in GLD or in SLV. Option positioning is what is acting like a shock absorber or an absolute catalyst, an accelerant, like pouring gasoline on the fire. Now, when you mix all of those things in together, all of those variables, you have to think about the main backdrop of all of it, the main driver of all of it. So we have our options, we have our speculative flows, we have our investment flows, but we also have the dollar. The US dollar is what dictates most of it. During major global crises, what happens? The dollar strengthens. You think, why? Why is the dollar strengthening? They're printing more money. They're probably going to be spending more money on armaments, on bombs. They're going to be becoming more indebted. So why would the dollar be appreciating? How does that make any sense? Well, because the entire global financial system is built around the dollar. The risk-free rate from US treasuries. Countries borrow it in dollars. Banks settle transactions in dollars. People settle trades around the world in dollars. The vast majority of global trade runs on dollars. So when the stress rises, everyone has to scramble for the dollars because they believe that the scarcity is around the corner. When are we going to get our next dose of dollars? Who knows? So let's go and get it now. Which means one thing. capital flows into US treasuries, into the US market, into US equities, into dollar assets. And when the dollar struggles, the global economy struggles. And when the dollar strengthens, it means the global economy is looking for the dollar liquidity. We saw this clearly during the early months of other cycles, before geopolitical events, geopolitical tensions all around the world. The dollar strengthened beforehand. What happened to gold? Again, it paused. What happened to silver? The same thing, it paused. The same thing happens during the early phases of most conflagrations, especially things like the Ukraine war. Everyone would have expected for the gold to go up hugely, but instead the dollar surged as investors looked to go into safe assets in the US. And metals, what did metals do? They moved sideways and they even moved down, which perplexed many people in the market. So once again, the mechanism becomes patently clear. War doesn't automatically mean a bid for gold. Dollar liquidity does. Debasement, printing, fiscal largesse, fiscal incompetence, the denominator getting bigger. That's what is the playbook for gold. It's never war, it's never famine. As much as that seems counterintuitive, that's the real game. Now, while we're on the topic of games, let's talk about the central bank game, because that's another distinct, important pillar in all of this. Here's where the story becomes either interesting or absolutely diabolical, because central banks themselves are quietly accumulating gold. Some are quietly doing it, some are bombastically doing it. In fact, over the past 2 years, we've seen the largest central bank gold purchases in modern history. China has bought for the last 18 consecutive months. Countries like China, Russia, Turkey, Poland, India, and several other nations around the world are aggressively increasing their gold reserves. But why? The natural corollary of that is the question, why? Because this doesn't just happen randomly. It happens when trust in the global system begins to erode. Massive debt levels, huge bills, unfunded liabilities, persistent inflation, sanctions, tariffing, sanctioning, weaponizing the dollar. All of those forces are encouraging governments to diversify away from dollar reserves. But this buying is happening slowly. It's happening quietly for now. It's happening strategically and it's happening methodically, because like any junkie, you can't come off the stuff cold turkey, or you don't want to alert the people around the way that you're doing it slowly at least. Central banks don't want to create that panic. They don't want to show that their reserve allocation and their makeup of their reserves has shifted entirely, because it would create panic, it would create a run, and they'd have to buy gold at ever increasing amounts in price. So what do they do instead? They accumulate over years. That's why we have a huge bull cycle in these metals. It often lasts 10 years, because these cycles, they last 5 to 10 years. So they accumulate slowly over years, which means the visible price of that gold that you're buying may move slowly. But if you elongate it along a certain time frame, you see the clear picture of what these banks are doing. The pressure is building behind the scenes, but it just hasn't leaked out yet. Now, I've been talking about gold a lot, but gold's relatively volatile cousin, silver, is even more interesting for a variety of reasons. So let's talk a little bit about silver. Now, silver makes the story even more complicated. In some ways, far more obfuscated actually, because silver is not just a monetary metal anymore. It's also an industrial metal. It's used in high-tech stuff. It's used in AI centers. It's used in cars. It's used in catalytic converters. It's used in weaponry all around the world. Silver demand depends heavily on manufacturing cycles, okay? Which means recessions really matter, and nascent new technologies also really matter. Electronics, electrification of the grid, solar panels, decarbonization, industrial production, which means silver's price reflects two things, whereas gold's often only reflects one. Silver is more monetary demand and industrial demand, whereas gold is purely monetary demand in most cases. When economic growth slows then, what does that mean? The industrial demand for silver is obviously going to weaken. So if that is the play for silver, we have to be looking at it from a two-pronged attack. And that can offset the bullish monetary forces that would normally push silver higher. So it's not just about the simplistic deduction, I call it simplistic, lightly, but it's not just about the one variable deduction that we make with gold. This is why silver often lags gold during periods of economic uncertainty. And suddenly it explodes when the liquidity comes back in. We saw this time and time again, most poignantly in 2010. Silver went from $18 to $50 in less than a year. That's a bigger move than we've experienced right now. So these moves are possible and they're sustainable. But it wasn't because war started. It wasn't because the world was on fire. It wasn't because there was conflagrations in the east and the west and the north and the south, but because the liquidity conditions had shifted. So we need to stop thinking that these metals react to war, that they react to crises. They react purely, always and only, everywhere at the same time, to liquidity, capital flows, central bank debasement, largesse, monetary printing, erosion of trust. The real reasons are those. Now, to close up, to sum this all up, let's put it all together, let's put all the pieces together, let's bring it all back home. Well, I hope I've done the best. I don't claim to know everything, but I've done my best, right? The real reason silver and gold, in summary, aren't exploding right now is surprisingly simple. The system is still in a holding pattern. Liquidity hasn't broken yet. Central banks are tightening slowly. Interest rates remain historically elevated, and dollar liquidity is still majorly, predominantly dominant. Options positioning is absorbing the pricing moves, and that's why we're seeing this range between 5,000 and 5,400. And any break below it is being bought up aggressively. The financial plumbing is still functioning, and thankfully as well, because gold at 10,000 implies something really, really wrong is going on. So in that interregnum period, metals are going to obviously just drift sideways. But history shows that suitably doesn't last forever. It doesn't last for a very long time, that drifting sideways. Something always eventually breaks. And when it does, the reactions in metals are absolutely explosive. So, just in summary, one more time before I close this video up, the real reason that these metals move isn't because of war, it's because of liquidity, debasement, erosion of trust, and all of the other things I've mentioned. But before I go, let me just leave you with a lesson from history.
Hail the bank! Hail the Imperium!
From a long, long time ago, some of you might have been alive, well, I actually find that quite impossible, but maybe, who knows. 1931, the global financial system appeared absolutely stable. Central banks insisted everything was under control. But beneath the surface, what was happening? The system was creaking, cracking, buckling under its pressure, undergirded by things that were paper promissory notes. Bank failures spread across Europe with feverish pace. Currencies were collapsing all around the world, and suddenly gold flows exploded across borders as nations scrambled to do what? To protect themselves, to protect their reserves. And what happens to the public? The public, as always, only noticed when it was too late. They weren't the beneficiaries, they were the victims. Not of a malevolent system, but of a system that was unclear to them. By the time gold became the headline story, the crisis had already started, because financial pressure always builds quietly, and then suddenly it leaks. But the leak is not controlled. It's always messy. The pressure right now, you best believe it is building. So if gold and silver aren't exploding right now, it doesn't mean the risk is not there. It doesn't mean the risk has completely disappeared or has been dampened, softened, ameliorated. It simply means the plumbing hasn't broken yet. There's cracks in the pipe, hairline fractures, but it just hasn't become diluvian in its flood nature yet. It simply means the plumbing is still intact. It's being held together. But war alone never drives the metals. It's always the liquidity. And the real story here isn't what's happening on the battlefield. And we all hope and pray that these things get resolved soon. It's what's happening inside of the financial system. It always is. The options positioning, the dollar liquidity, the erosion in trust, the central bank signaling that easing is coming, central bank reserves growing in terms of their composition of gold instead of dollar reserve assets, derivative hedging. All of these things are the signals, the forecast, the prelude to what's actually coming, which is increased stimulus, increased governmental largesse, increased profligacy, and a higher increasing gold price. These are the mechanisms that quietly determine what's going on in the world. Most investors only notice it once the prices explode. By then, the move is already fully underway, fully priced in, because the pressure inside the financial system builds and builds and builds, and it behaves just like the fluid dynamics inside a creaking pipe. It builds slowly, but it builds surely. It builds silently, but it builds violently. And by the time it finds a suitable exit valve, it goes out by the path of least resistance, which doesn't mean the prettiest path, which doesn't mean the most diplomatic path, but it means it's the path that everyone sees in the price. That's exactly where the pressure is going to leak and how it's going to manifest. Make sure you're on the right side of history. Make sure you're on the right side of the bid-ask spread. My name's Justin Banton. This is the House of Trade. Like, share, and subscribe. Ciao for now.